I do think that's a real kind of catalyst here, that it's just forcing everyone to put this in their models. This is something that I was not aware of until yesterday. The pricing last April, so April of 2023, was at around $482 per kilowatt hour. This is just based on a screenshot Sawyer's shared from that time. I went to Tesla's Megapack website yesterday and just like for this exact same project, so it's apples to apples, what was the pricing? And if you look at that, it's a $266 per kilowatt hour new price. So over a 40% reduction in a little over a year in the pricing. So like while deployments are, let's say, doubling or like more than that, if pricing is coming down significantly, that's certainly going to limit the upside potential in terms of revenue, and it might also present a fair amount of margin pressure too, which it's certainly remains to be seen how much unsatisfied performance obligation, like that pure margin kind of tailwind that we talked about, is probably going to be offset pretty significantly by this headwind of lower prices. But a couple important points here. One is that like the pricing from previous projects is still going to be honored. So like a lot of the revenue that they're recognizing in Q2 is going to be for hitting the milestones of a project that they initially signed up a year ago or 18 months ago, just as it's hitting those milestones. So that will be at the higher pricing, but those contracts also have a pass-through in lithium carbonate price, which is one of the most significant drivers of price. So the Tesla's revenue, like the dollars per kilowatt hour that they're seeing, is probably going to decrease. But that's also very much offset by the lower lithium price, and like Elon has talked about, the being flooded with cheap cells that's going on right now. So that both of those things are going to limit a little bit the revenue growth potential that you might calculate if you just did like a pure one-for-one extrapolation of the deployments.
But the gross margins and the proportion of the deferred revenue to the total revenue would still be the same-ish, right?
It might even increase. As I'm thinking about it, because like I actually was developing a power plant project a number of years ago, and one of my jobs was actually to calculate the liquidated damages. So we were buying equipment from GE, and it said like a guaranteed output rate and all these other, like a heat rate, all these different components, and you can do the math of like what does that actually cost you, the project owner, if the equipment doesn't perform as you were expecting. And so like there's very easy, or not easy, but there's very clear ways you can run those calculations, do a present value on it, and say, okay, like if you are short 1 megawatt on me, here's how much it cost me. And so then you like stick that in the contract, parties agree to it. You say like, yeah, just based on market prices, that would be your harm if my equipment didn't perform to the level that I guaranteed. And that's like that level of harm is not going to change because the overall contract price decreased, because it's more about the forward like revenue and margin opportunity of the project. It's not about the cost. So as I'm thinking about it, actually, probably that piece of the equation is going to increase.
I've been trying to think about the way that all this revenue recognition is spread out. And what I'm wondering is if there is essentially a way to do an 18-month trailing deployments average and associate that with current revenue recognition, and then use that to project forward based on monthly deployments at this point in time.
I actually did that about 18 months ago. And kind of what I found is that it wasn't giving me any more accuracy than a more simple model where you're basically just making an estimate of the deployments and the estimated dollar per kilowatt hour. Given the huge spike that we have right now in deployments, that might be more beneficial today than it had been in the past. Because this is actually one of my key questions. Like as I'm looking at my model right now. Q1, my estimate was an average storage price of $366 per kilowatt hour, and you had 4 gigawatt hours. So now I've got 9.4 gigawatt hours being deployed, more than double. What's a reasonable way to estimate the amount that's going to be recognized? Like, do you take that 366 number and like cut it in half because so much of the deployed is going to be recognized later? It's probably not that extreme, but like I could make an argument for it to be like 350, and I could also make an argument for it to be like 250. So it's going to be very hard to tell. And so if we have revenue this quarter that's like 3 billion on the energy side instead of 4, then I think that will warrant modeling it in the way that you suggested, Hans, and that's probably what I'll end up doing because it is. But even then, like there's this huge spike that we are seeing recognized. Like you have no visibility into when those milestones are going to be met. You can make an estimate, just kind of assume it's smooth-ish, but like you could just randomly have a bunch of the projects get to commercial operations in, I don't know, Q2 of 2025 and not very many in Q3. And you'll just have like a massive bump, even if deployments don't necessarily spike in that quarter. So it's going to be a little lumpy. And there's really, because we've got such imperfect information, it's going to just be an estimate no matter how you do it.
This energy thing has been a dormant thing that we've tried our best to understand how it's going to play out in the future. And it's every time it's been disappointing, right? It's like, oh, here it comes. Nope. Oh, here it comes. Nope. Oh, here it comes. Nope. But now that it seems like we have the first signal that says, oh, it's here now in some way, right? But it's interesting because if let's say the growth in gigawatt hours in Q2 versus Q1 correlates closely to the revenue growth we're going to see. So we'll go and say the margins stay relatively the same around that 20 to 25% margin. You all of a sudden you're adding close to $1 billion of profit to the bottom line. Like it goes from a $400 million a quarter gross profit business to about $1 billion, right? And then if you put this within the context, so the math I'm doing there is if I look at Q1, energy generation and storage, 1.6 billion for revenue, and then COGS is 1.2, so that's 400 million profit, right? And then you times that by 2.5-ish, you'll get to about $1 billion, assuming that margin's the same, right? And then we're not talking about deferred revenue or anything like that, which we think will come later. But even just there, so all of a sudden, Tesla is able to unlock a total of about $4 billion a year of gross profit that will flow to the bottom line in some way to help them fund their AI stuff, right? And this thing could potentially set to grow once Shanghai's live in 2025, late 2025, whenever that's fully ramped. To your point, that could add yet another 40 gigawatt hours of volume, which will increase revenues by another 2x or 1.8x or whatever that math is, right? Which will, if margin stays the same, then all of a sudden, to your point, you go to $2 billion a quarter of gross profit, $8 billion a year that Tesla can again use to fund their current operations on top of the profit they're getting from their vehicle side, which I also want to talk about if you have time, because now we might have this dynamic starting Q2 where you're going to have return of gross margins potentially above 20% for the auto business, especially as Cybertruck is ramping up and Tesla pulls the lever on interest and low interest rate financing, so on and so forth, right? So it's like, it's just fascinating to see, like all of a sudden we're talking about another $1 billion of profit per quarter that could come very shortly. It's
really nice. And that $1 billion, like you said, I mean, if you kind of tax affect it and you get to, let's call it 3 billion, just to be a little bit on the conservative side, assume some operating expenses. That I lost my train. My mental math capacities just completely exploded live there. Annualized it'd be like $3 billion, which is like $1 per share. So, and like when I was doing the math this quarter, I was like, holy crap, I can't believe how much earnings growth sequentially just came out of the energy side of the business. Because it was like 15 cents per share when I was assuming something like 40 cents per share all in. And so between like the energy sales beat and the auto beat, it's like, okay, my expectation was like mid 40s, and now I'm calculating like low 60s. So it's an immediate benefit. But then I think the more important thing for investors is to say, okay, like regardless of like the revenue recognition and like all this like accounting nonsense that like matters, but it also doesn't really matter. Like just think about the long-term picture. And so like, I don't know exactly when projects are going to recognize revenue or what the ultimate pricing is going to be, but we know that Lathrop and Shanghai are both going to be doing 40 gigawatt hours at some point in the future. They're going to grow like after that too. But like just do some simple math where you say, all right, $40 or 40 gigawatt hours annually, And let's assume pricing is low, like we're assuming here, or like their newest pricing is. So let's just say it's $250 per kilowatt hour. Well, then you're doing 10 billion in revenue, and it, like, if you want to, you can just make whatever margin assumption you want. If you want Larry's assumption that it's like 35%, if you want to keep it just conservative, let's just say it's 25%. Then you're talking $2.5 billion in margin, like, very soon. And like that's just like very meaningful, like end of next year kind of time frame.
And this is a growing business too, right? So this isn't like between Lathrop and Shanghai you have 80 gigawatt hours, right? This is like this is where we're starting from, and then it's going to continue growing as more and more markets adopt this technology, right? So like what I'm thinking through right now is, if we think about what happened to the stock price in the last week or so, is this the market recognizing this, or is that something else, right? Because when I think of this business, like, the whole thing I'm trying to figure out here is, like, is this finally the lever that gives somebody like a Warren Buffett the thing that says, ooh, easy business to understand, incredibly high demand, make batteries, slap them into the place, walk away? Is that finally the thing that gets those big money guys to jump in and say, okay, now this is simpler. It's not based on this super long-term potential. I know the answer is no, right? But it's like, I wonder if there's a little bit in there that's like, okay, it can't get any simpler than this. You're buying batteries, or you're making batteries, you're putting them in a box, and you're slapping it into a thing. Like, you get a cabinet, you put batteries in there, and you put the cabinet in a place. How fucking hard can that be? It's hard, but I'm saying, like, that doesn't seem like a hard concept to understand from an investment thesis perspective, right? I don't know.
That's not the hard part. The hard part is who the customer is. And I'll let Matt talk about that.
I do think, Farzad, it's actually a good point. Like, I'll kind of take issue with the fact that the business is super easy, but I do think, if you're just some institutional manager of funds, and do I invest in Tesla? And the story 6 months ago was, well, auto sales really suck, but hey, FSD looks promising, and like robotaxis could be big. Like, that you're kind of betting on the come there, to like Elon solves it and it'll be great. This, it's so much easier to wrap your head around. Like you were saying, you can do the simple math of, like, okay, how much does the business grow? What are the margins? And like, the thing that I think is so compelling is this is a business that's got 25% gross margins right now. Let's just assume that we're going to be reasonable and assume they stay there. And it's growing at triple digits. like if we're talking about potentially billions of dollars of margin next year, what kind of PE multiple should you apply to that? Like if your top line is growing at 100%, and you have a goal of going from let's say a run rate last year of like 12 to 15 gigawatt hours. You're going from that to a long-term target of like 1,000 gigawatt hours, which is a terawatt hour. Like the runway here for very high growth at very good margins is extremely long. So I do think that, like, this is easier for some institutional investors to kind of wrap their head around and say, oh, I was ignoring energy because it has sucked forever, but now it's becoming real, and there's like easier for me to put this in my Excel model and say, oh, like, actually I've done the math and I think it's worth $200 billion, whatever your math gets you to. That's very easy to kind of then add that to your model and say, okay, well, I thought it was worth 170 a share, but now that I'm doing the math, I can pump it up to whatever 250 or something like that. I do think that's a real kind of catalyst here, that it's just forcing everyone to put this in their models.
And then how much of the glut in batteries that Elon's been talking about, which we've seen, so like all the auto manufacturers like GM and Ford and everybody else that has been delaying plans, canceling plans, which is putting suppliers in limbo with potential manufacturing capacity that they've built out, and then these guys have decided to pull back because they can't make an EV at a profit, right? And so in the current glut of batteries and the plummeting lithium prices, which in theory is going to give Tesla the ability to bring in much cheaper cells in the next 12 to 18 months, how much of those batteries are interchangeable between auto and energy? I'm assuming every single one of them, right? Well, yeah, I'll let the expert answer that question.
I mean, Tesla's strategy, I think, on both the auto and the stationary storage side has been to be very flexible with their cells. And that has been a tremendous benefit to them.